For more than a century, Coca-Cola has survived almost everything. World wars, economic recessions, financial crises, inflation, changing consumer tastes, and now, an entirely new era driven by artificial intelligence. Yet through every cycle, one thing has remained remarkably consistent. Coca-Cola keeps winning. Not because it makes the best soft drink. Not because consumers have no alternatives. And certainly not because luck has been on its side. Behind this familiar red logo is one of the most durable economic engines ever built, a business that has repeatedly turned a simple product into extraordinary shareholder value. So what makes Coca-Cola so difficult to beat? Why has it remained one of the world's greatest compounders while thousands of once famous companies have faded away? The answer has very little to do with the drink itself. It has everything to do with the business behind it. Let's take a closer look. At first glance, Coca-Cola looks like a simple beverage company. It makes soft drinks, sells them across more than 200 countries and territories, and reaches billions of consumers every year. But over time, investors have come to realize that Coca-Cola's success is about far more than the beverages it sells. Behind every bottle is a global system of iconic brands, local bottling partners, and an unmatched distribution network. Together, they create a business that is far more difficult to replicate than the product itself. Strong brands are valuable. But truly exceptional brands do something even more important: they give a company pricing power. Over the years, Coca-Cola has demonstrated an ability to raise prices without significantly reducing demand. That's because consumers aren't simply buying a beverage. They're buying familiarity, trust, and a brand they've known for generations. That pricing power helps protect margins during inflation and creates a competitive advantage that few consumer companies can match. A great brand attracts customers. But a great distribution network makes sure the product is always within reach. Today, Coca-Cola's beverages are sold in restaurants, supermarkets, convenience stores, vending machines, and countless small retailers around the world. That level of availability didn't happen overnight. It was built over decades through a vast network of bottling partners and local distributors. The result is a competitive advantage that makes it incredibly difficult for new rivals to match Coca-Cola's global reach. Over the past decade, Coca-Cola has reshaped its business into a more asset-light model. Instead of owning most of its bottling operations, the company now relies on a network of independent bottling partners to manufacture and distribute its products. That allows Coca-Cola to focus on what it does best: building brands, developing new beverages, and producing its high-margin concentrate. By reducing capital-intensive operations, the company has improved efficiency, strengthened profitability, and generated more cash with less capital invested. By now, a clear pattern begins to emerge. A trusted brand creates demand. A global distribution network turns that demand into consistent sales. And an asset-light model allows the company to grow without tying up excessive capital. These advantages work together, not independently. They help Coca-Cola generate healthy margins, strong cash flow, and consistently high returns on invested capital. For investors, those financial results are more than just impressive numbers; they're evidence of a business model built to create value over the long term. Strong profits are important. But cash flow is what gives a company the flexibility to invest for the future. Year after year, Coca-Cola has generated substantial free cash flow, even through challenging economic environments. That cash allows the company to invest in its brands, expand its beverage portfolio, support innovation, and return capital to shareholders. It's one thing to report earnings. It's another to consistently turn those earnings into cash. Generating cash is only part of the story. What matters just as much is how that cash is allocated. For decades, Coca-Cola has followed a disciplined approach: reinvesting in its brands, expanding into new beverage categories, making selective acquisitions, and returning capital to shareholders through dividends and share repurchases. This balanced capital allocation has helped strengthen the business while rewarding investors over the long term. It's one of the reasons Coca-Cola has continued creating value across multiple generations. Of course, no business is immune to change. Consumers are becoming more health conscious. Governments continue to introduce sugar taxes in some markets. And competition across the beverage industry remains intense. Yet Coca-Cola has spent years expanding beyond traditional soft drinks into water, coffee, tea, sports drinks, and other growing categories. Rather than relying on a single product, the company has built a diversified beverage portfolio designed to evolve with changing consumer preferences. No business is without risk, and Coca-Cola is no exception. Changing consumer preferences continue to shift demand toward healthier beverages, while sugar taxes and stricter regulations in some markets could weigh on long-term volume growth. The company also faces rising commodity costs, currency fluctuations, and intense competition across multiple beverage categories. At the same time, new trends, such as the growing popularity of GLP-1 weight loss medications, could gradually influence consumer eating and drinking habits, although the long-term impact remains uncertain. For investors, these risks shouldn't be ignored. But they also need to be viewed in the context of Coca-Cola's global brands, diversified beverage portfolio, pricing power, and decades-long ability to adapt. The real question isn't whether risks exist. It's whether those risks are strong enough to weaken Coca-Cola's competitive advantage over the long term. More than a century after its founding, Coca-Cola continues to demonstrate what separates a great business from a great investment. The quality of the business is built on enduring competitive advantages that have allowed it to adapt through changing consumer preferences, economic cycles, and competitive pressures. That doesn't mean the company is risk-free, and it certainly doesn't mean the stock is always attractively priced. Valuation will always matter. But history suggests that businesses capable of generating consistent cash flow, earning high returns on capital, and adapting over time are often the ones that create lasting shareholder value. Whether Coca-Cola deserves a place in your portfolio is ultimately your decision. But understanding why it has remained one of the world's most resilient businesses may be far more valuable than simply knowing what it sells. And perhaps that's the real reason Coca-Cola never stops winning. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.